Everybody, welcome to another Steady Wealth podcast episode. I'm your host, Serge Berger. Today, we're going to have a look at the options market. And as a lot of you probably know, I'm quite a proactive trader in options. We also use it for investing portfolios at Blue Marlin Advisors for our clients. And again, obviously on the trading side. And what I'd like to do today is give you a bit of an insight of where we see the analysis we're getting from the market, the options traders' insight into the recent market rally and what we think the summer months have in store for us. In general, what we continue to see is a lot of concerns around the more macroeconomic environment. And the macro environment is not something that a lot of traders tend to focus on too much because it's very near term, but they should, because the tailwinds or headwinds are always going to come from a macro environment. One of the things that I've struggled with, in full disclosure, over the past 4, maybe 5 months, maybe 3 to 4 months, is the really strong, what I still think is a counter trend rally. And when we look at break the markets down into macro and then fund flows, we have to understand the differences in terms of time frames. When we look at macro environments, those are the kind of things. Macro stuff tends to dominate markets, but more through the lens of multiple quarters and years. So those are the big tail or headwinds. But fund flows, and that's really also where we get a lot of information out of the options market that I want to talk about today, they really tend to dominate more in the multi-week, multi-month time frame. And that's where we're getting a lot of insight. We did see, in full disclosure, the market getting more and more bullish and people off sides and short in the options market. But to me, the macro having gotten so much worse has trumped that feel. But now we're getting to extremes, depending on when you watch this, we're getting to extremes in terms of markets being overbought again. We just had another statistic out today where the sentiment of retail investors is finally back sky high. It literally took about 3 weeks for that to happen. They are chasing at more or less the wrong points. Just quickly, though, a couple more points on the big picture. So U.S. industrial production, for example, last week slowed to about, I think, 20 basis points year over year. That's literally straight down. And we've had China horrible export data. We have PPIs, CPIs all coming down. Pretty much any sort of the more regional Fed surveys, they're all slowing. But why is the market rallying, right, is really the question. What we tend to notice is when you have options expiration months, particularly the big ones, the quadruple witching ones, which happen, I think, 5 times per year, March, June, and then so on and so forth. As we are approaching the June one, you tend to see these exacerbated moves. And I want to just give you a few statistics here, and I will share my screen with you as well here in a second, so you can see this a little bit more directly as well. Before we look at that data, though, I think let's quickly just go, and I'll share my screen with you guys right now. Let me do that. There you go. So what you'll see here is data that kind of summarizes what I'm about to go through more granularly, because a lot of times we get requests from people asking, hey, when you look at the markets, how does the options market tell you where things may or may not go? And what I will tell you is that the options market has become increasingly large. So it used to be that we looked to the bond market for signals, and the bond market still gives you the macro stuff that I said before. Like, that's really what that market's good for. But for more multi-week, multi-month, the options market can tell us a lot. But it doesn't always work, right? You have to pick the right spot. So let's have a look at this chart here. And this is, I think, one of the main things that we want to look at when markets are extremes. It doesn't help that much when markets are not extremes, but when markets are extremes, we tend to see this play out notably. So what we see here is, in blue, we have the NASDAQ 100, which of course has been going higher. And at the bottom, we have volatility. It shows specifically here the NASDAQ volatility as opposed to the VIX. And what we can see is that we continue to rally vertically, but we're starting to make marginally higher lows and implied volatilities. I want to show you in a minute how we can calculate that even a bit better, because the VIX can be a little bit misleading. I still think it's a good indicator, But because of all the flows and people selling volatility and systematic vol targeting, all those kinds of funds out there, we need to be a little bit more detailed and actually look at behind the scenes what's actually taking place. And I'll show you how we can do that in a minute. One of the things I want to show you though, and this is something that we look at a lot, is volume and what kind of strikes people are buying and so on and so forth. And we're seeing, once again, just a ton of activity on the call side. In fact, we've seen so much call buying volatility of late that the volatility, implied volatility on calls, is now actually higher than it is on puts. Usually, volatility on puts, implied volatility, is actually higher. So puts tend to be more expensive. Why? Because naturally, people tend to hedge themselves. So there's more sort of demand for hedging activity on the put side. But when you get these manias and these real vertical moves, like arguably I think we're having right now with that blue line going vertical, that's the NASDAQ 100, people get so greedy that the calls actually start to see implied volatility rise above that of puts. So that's an extreme reading, and we want to be aware of that. On top of that, last week on Thursday, we actually saw the largest ever call buying activity in the S&P 500 ever. So I think it was almost 1.89 million contracts in one day. In fact, a couple of weeks ago, I want to say maybe 2 or 3 weeks ago, we saw more call buying activity in Tesla and I think Nvidia or Microsoft, I can't remember, one of the two, than in the NASDAQ, Russell 2000, and S&P 500 combined. That's how crazy the speculation is once again. So again, these are all data points that we look at and how we help our clients navigate the waters, and how we're doing it ourselves at Blue Marlin as well for our clients. Now, what tends to happen, the steeper these moves get, the more, and I'm going to bring over another chart here so I can show you this as best as possible. Here we go. Let me bring down this chart. The crazier the moves get in terms of extension, the faster the moves also get, and the more irrational. So one of the things that we like to look at is how extended a stock might be above, or an index, let's say above its 200-day moving average. It's a simple way of looking at it, but you can see, like right now, for example, the S&P currently, as I'm recording this, is trading just about 10% above its 200-day, versus about it having traded about 8% above its 200-day at the all-time highs back in January the 22, late 2021, December. We've seen the S&P trade farther above its 200-day before, but not in this kind of an economic environment where we are once again in a situation where, again, as I said before, economic growth continues to slow. So what ends up happening is that the at-the-money volatility tends to increase quite notably. And when that volatility, the implied volatility, starts to increase underneath the surface, we want to be very careful, particularly if this happens into what remains a very weak economy, or in a weakening economy. I need to be careful what I say here, and into one of these quadruple witching options expiration days. So I think that's important. At the same time, what we're seeing here is we are seeing the Fed actually has gotten more hawkish over the past number of weeks. And I think the equity markets, it's just ignoring that. But again, if we start to see what the options market is doing, and I'd like to show you guys an actual example here so you can see this. If I can quickly detach this. There you go. Okay. What we're seeing is that the options market, which again tends to be, I'm going to argue, a little bit smarter than just the equity market itself. Not so much retail flows, but what's happening. So we just, as a channel check, I do a channel check twice a week with analysts, with hedge funds, and people I work with and talk to throughout the week. And what we're seeing is a lot of people buying a lot of protection again. It hasn't yet hit mainstream, which is why the VIX, as I'm recording, remains quite low. But that's another point. In fact, I should maybe quickly mention this. There's this idea out there that when you have these low VIXs, like 14, 12, whatever it is, that is extreme, and it is extreme, and that the market should immediately sell off when that happens. In reality, what you need to see is the VIX rise a little bit, maybe to 16, 17, 18, and then the market starts to react. So it's like a rope that has to first get rid of the slack until it hits. So when you tow a car, for example, you have to go a few feet until the line's actually straight. So that's another point to watch out. So we've seen the VIX rise a little bit here over the past few days. And so I would expect the VIX to have to be closer to, again, I don't have the exact number. It could be 16, 17, 18 before the equity market starts to move. So again, the move lower. The bond market too, but the options market is certainly smarter than the equity market in that sense. So to give you an idea of how we can double check the VIX or even look closer into things, what we can do is we can look at something called fixed strike volatilities. It's basically what it means is like, what is the implied volatility of a given strike? And you compare it sort of day over day. And so what we like to do is I'm going to just take, for example, July options on the S&P 500. And I know, for example, a few days ago that, let me make this a little bit lower, they closed around an implied volatility of about, let's see here, I think 11.4 or something like that. Yeah, it's a 438 call, was trading at an implied volatility of 11.46. The following day, on June 15th, the equity market rallied quite strongly. So 11.46 implied volatility. Let's go back forward one day, so the 15th of June, and you can see 438. Oh, it's only showing 4 strikes. If I show you all the strikes or the 438 call, you can see it's now 12.6, let's say. That's 100 basis points higher. Now, that's not huge yet, but that can change quickly. But the point is still, the equity market was rallying on that day, on the 15th, yet implied volatility didn't actually go down, it went up. So if you want to double check what the VIX is, you can look at something like that, and then you can look at that at different expiration points. I was looking at July. If we were to do the same exercise for August and so on and so forth, we would get a very similar reading. In this case, I've already done that math for you. So I think that's an important thing to look at. Now, why are we so concerned about the market right now, and particularly with the options markets telling us if you take all things together? If we look at what the liquidity situation looks like in the market, it's actually very dire. And what does liquidity mean? And I'm going to just leave a random chart here, so I will stop the screen sharing here. When we look at the macro environment, there's a lot of underlying factors right now that are causing liquidity to come out of the market. What does that mean? For example, we have the Treasury General Account that needs to be refilled. So that means the Treasury is going to have to issue a lot of bonds. I think this has been talked about quite a bit, but again, it's not so much one point, it's all the things together. It's the extremities of emotions that are taking place once again in the equity market. It's the options market telling us that this is a problem and that smart money people are going in and buying puts, again, by implied volatility having gone up a little bit. I'll show you the VIX and if we get to it a bit later. But we also now have liquidity coming out of the market. In fact, central banks were providing liquidity after the SVB went bankrupt and a few other regional banks in March, April. But now that's about to flip. Now, again, this usually doesn't happen overnight because this takes a bit of time, but we have that is going to take place. Then student loans, I believe I'm going to say August or September of this year at the latest, or maybe it's even earlier, where student loans are no longer going to be forgiven, meaning people have to start repaying them. So that's going to give a lot of people less money to spend. So keep that. That's another thing that's withdrawing liquidity. I think jobless claims are going to rise. That's going to be a natural function of the slowing economy. I gave you some anecdotes of that before. Then interest rates, meaning deposits basically of banks, are leaving, right? They're being allocated to treasuries and other things like that. So bank deposits go into maybe an ETF that is invested in treasuries or something like that. That reduces liquidity on the bank side. We still have quantitative tightening and a couple other things, right? So you see, when you start to put that picture together and you look at the options market, what the options market starting to tell us, it starts to help us paint a picture that is quite dire, to be blunt, but also one that is very difficult to time unless you have an inflection point. That gets me back to the point that I mentioned before, which is the whole idea of these quadruple witching option expiration days. And The options expiration days are important because the big ones particularly, because that's where there's a lot of pin action. So let me share my screen again so you can see what that means and get a bit of a head around this. So if you look at, for example, round numbers, so the S&P 500, as I'm recording this, is having a lot of pin price action around 4,400. And you can even look at big stocks like Apple, for example. Oop, that's the wrong stock, APL. That is also moving towards round numbers. Maybe it's 185. Maybe, for all I know, it could be 190. So there's lots of games being played by options players for round numbers. The trouble is when those options expiration days hit, and there's actually on the quadruple options expiration days, there are a bunch of options that already expire at the beginning of the day, right? So this tends to happen like in the mornings already is when things start. A lot of this starts to unwind, and all that pinning action, that bullish action in options was basically a head fake. And to some extent, this is an old game. We know that market makers in the past have done things where they would get a stock to a certain point and then kind of take the floor and pull the rug underneath. It's a similar thing. So you just need to be careful. And that's, to me, that's why it's so important that we look at the relationship of options volume, particularly around these big option expiration days. Again, quad-witching, I believe it's 5 times a year, maybe 4, but I think it's 5. And how implied volatility reacts to that, which gets us back to the chart that I showed before. And again, it's not a perfect correlation, but it gets more and more accurate the more data we pile on top of that. We can now add in seasonal analysis on top of this. We could add in maybe earnings season that's going to come up not too soon, summer, astrology for all I know, which I don't track. There's a lot of stuff we could line up to get more and more things telling us the same thing. So it gets me to the point that I said at the beginning of this quick podcast, which is, again, when you start to see indices go vertical, and again, it's not an exact science. I can tell you, I read research all the time. I read a big piece of research this morning. I'm not going to show you the issuer of it. And they've been calling for the S&P to top out in April, and they were totally wrong. Now, in the end, if they're wrong by whatever X amount of percent, I don't care too much as long as it works within a few months. But that tells you how difficult it is. But the more we look at the options action and we can analyze that, and I think that the more accurate we can get, we can nail it down. So options volume matters. I want to leave you with a big point here. Now, even though we actually had more put options starting to trade, we still have calls being priced at a higher implied volatility than puts. And I'll stop the screen share, but I think that's something that we just need to really understand how. Oh, I don't even know if I shared the screen before. Doesn't matter. The point is, when we get to a situation of extreme and we understand that the macro environment does not support a new bull market, which we don't think this is a new bull market, right? I know some people are saying 20% off the lows, but that's 20% is a few stocks, right? The market breadth and everything doesn't support it, certainly not yet. And when you see a move like this into an options expiration day, and you start to see underneath the surface that the smart money is absolutely not buying calls anymore. In fact, they're buying puts slowly but surely. And up until recently, up until a day ago or so, we had calls still being more expensive than puts, which very rarely happens. Those are inflection points that we want to keep an eye on. So that's the kind of stuff that we like to do. We are focusing on this quite a bit over on the Study Trader. So you can head on over to thestudytrader.com to get a bit more educated on that. And we would look forward to speaking with you over there. In the meantime, if you have any questions, by all means, send us an email, send us questions any way you want. The best thing to do that would basically just email support@thestudytrader.com. If you are interested in investment advisory and actually direct advisory, investment management, you can go over to bluemarlinadvisor.com or send an email to hello@bluemarlinadvisor.com. That's it for right now. Hope it was helpful, and we'll see you again in the next Steady Wealth podcast. Thanks for listening.